Thank you for joining us for another edition of You and Your Money. I'm Bryan, and this evening we will be delving into the topic of short-term insurance. And joining me this evening will be Craig Poger, Director of the Poger Group. Craig, thank you for allowing Werner to come on the show. I know he's taking a bit of your time. You've been chomping. You've got so much to talk about, but let me just get back to Werner. Last week, my guest was Werner Voss, a tax practitioner from Davy Voss Tax Practitioners. I promised Rodney and the viewers that I would answer the question tonight. For those who missed the show, we discussed important tax obligations. Although the episode is replayed daily throughout the week, I highly recommend visiting YouTube just to search for BDTV and select You and Your Money to watch it. Werner, there was a question from Rodney in Ilovo, which is critical for many who may become tax non-residents. This question was, we are relocating to the UK later this year, and I've received conflicting advice about whether I should apply for non-residency with SARS. What are the advantages and disadvantages of becoming a non-resident for tax purposes? I will continue to earn income in South Africa through an investment property that generates rental income. I also plan to retire from my retirement annuities, so I will have ongoing retirement income from South Africa. What steps should I take going forward in terms of my tax obligations? And his second email was, what happens if we decide to return to South Africa in the future? How do we re-enter the tax system? Werner has kindly agreed to come onto the show to spend a few minutes explaining the process. Werner, welcome to you, and thanks for joining us once again.
Thank you, Bryan. Let me get right into it in that case. To break residency from South Africa, two requirements needs to be met. You need to be physically absent or leave the country. And secondly, you need to have the intention to leave the country on a permanent basis. So once you've achieved or met those two conditions, you've broken residency, and the day you leave or depart, that is the day that you become a non-resident. However, what happens sometimes is people start spending time in different countries over a period of time, not being sure exactly where they want to retire or live on a more permanent basis. So what happens in those cases is you have individuals spending time in, for example, two jurisdictions. Let's call it South Africa and the UK. So once you start spending time in two countries, then what will come into play is what we call international law, double taxation agreements or treaties. And these treaties have tiebreaker provisions, usually under Article 4 of those agreements, which determines between the two countries where you will be a tax resident and pay tax. Now, under those, under Article 4 of the Double Taxation Agreement, there's about six criteria, but I'll just focus on four and to simplify it. So the two jurisdictions, if it's the UK and South Africa in this particular case, would then determine where the individual is a tax resident based on where his permanent home is. So, and that's the place where you and your family live. So, Bryan, if you have homes in two places, and you could argue that the permanent home is not a determining factor, then the test continues. And it continues all the way through until you get to the final test where the governments, if they cannot decide on where you're a tax resident, where the governments will then decide amongst themselves. But we're not going to go there tonight. To simplify it, we start with permanent home. Where's your permanent home? From permanent home, if it's not easy to determine where your permanent home is, then you'll move to what we call Center of Vital Interests. Now, the Center of Vital Interests have two tests to it. It has a personal test and an economic test. On a personal level, they will look at you, your lifestyle, your social ties, and with which jurisdiction that is closer. And from there, if it still cannot be determined on that criteria, if you've broken residency or not, then you move to Center of Vital Interest for economic, on an economic level. And the economic level, Center of Vital Interest essentially is where you earn your income from, where your bank accounts, where your investments are held. And if you still can't break residency at that level, then we go to the next question, which focuses on your habitual abode, which is the place to which you would regularly and consistently return, the place to which you would normally return after your worldwide earnings. So, Bryan, once you've broken residency, then at that moment in time, you become liable to an exit tax in South Africa. There's an application process that you have to go through. SARS looks into the matter, and then based on certain documents that you have to provide them with, proof that you've broken residency, SARS will then make you a non-resident on their system and register you as a non-resident taxpayer. Once you become a non-resident taxpayer on the SARS system, then going forward, you may still have an obligation to file returns in South Africa. Because remember, South Africa works on what we call a worldwide basis of taxation. That's residence plus source rules. So after you've left, if you've broken residency, you've paid your exit tax under Section 9H. It's possible
So,
that
Werner,
you may still
that extra tax that you're talking about, capital gains tax.
capital gains tax. That's correct.
Okay.
So that is your tax to leave the country because you deem to have disposed your worldwide assets on the date that you break residency. Now, from that moment onwards, to get to the second part of Rodney's question, then, for example, in his case, we have rental income. Rental income in South Africa is a South African sourced income. And as a non-resident, you have to file returns on SA sourced income. Income from an annuity would also be considered South African sourced income. And then you'll continue filing returns for as long as you have South African sourced income.
And Werner, where would you pay the tax? Let's say you're living in the UK.
The sourced income is taxable in South Africa. But remember, under the DTA, if it's taxable there and they've decided that you're a tax resident in the UK, your SA sourced income will be included in the UK on a worldwide basis of taxation. So you will pay tax in the UK on your worldwide income, including the South African sourced income. But you will be credited for any tax paid in South Africa on that SA sourced income. So that's what the DTAs are all about. It's the avoidance of paying tax on the same income or double tax on the same income. So, and that's why these agreements are so critical to look at in these cases where it's very difficult to determine where you're a resident and also what your sources of income are and where they should be taxed if it could potentially be taxed in two jurisdictions. Maybe just to finish on the last part of, to get to the last aspect of Rodney's question is the fact of what happens if you are a non-resident and you decide to come back? Well, a similar mechanism is available in e-filing. As you would inform them that you've broken residency on a particular date, there is now under this in the 2025 tax season functionality being rolled out on e-filing where you can now change your status to becoming a resident during the tax year. And then from that moment, having informed them of your residency, you will then file tax returns as a resident on your worldwide income going forward. It usually was very difficult to get back into the system once you've broken residency. But I think sensibility prevailed at the SARS offices, and they decided they need to create a mechanism for individuals that have left the country, and it happens regularly. I mean, you're well aware of it, where people decide to go abroad and then things don't work out, they don't like the weather, and then they come back. And to get them back into the tax system, they've now created this functionality, which has only been available from the 2025 filing season.
Werner, thank you very much. I'm sure I'll have a lot more questions after this program. We'll chat soon. Thank you for joining us. Craig,
you're welcome.
Thank you for giving up time. It's lovely to have you on the show. And really, Craig, in that 2024 National Finance Ombudsman's non-life business report, they showed that they had claims referred to them of approximately 107 million rand. Over 20%, that's 22 million, was then paid in favor of consumers, recommendations made back to the companies to pay the claims. Now, that's an enormous amount, and I'm just wondering what is happening with companies and consumers. Why is this necessary to have to refer repudiated claims to the Ombuds Office only to have it then evaluated and suggested by the Ombuds Office that that claim be paid? What is happening in the market at the moment?
So
Difficult market?
Difficult market. I think the positive here is that there is an office like the Insurance Ombudsman to deal with these type of queries and claims, which is an impartial office, which is positive for both the insurer and the consumer. While the number of claims is that the policy wording is changing and does continue to change over the period of time. It has become more complicated, and the terms and conditions of policies are very often misunderstood by the policyholder. Hence, the reason why a broker is so important, because what actually happens in the real world is that there's a claim and the policyholder doesn't understand the terms and conditions of that specific mode of policy, excesses, regular drivers, things like tracker warranties, and all of these things come into play. And that, as a result, leads to misinterpretation of the policy, and hence these claims going into the Insurance Ombudsman space.
But does that mean that the claims department, the managers, the people in the claims department themselves don't have a full understanding? How come it gets referred to the Ombuds office? And I've just got some numbers here which I just thought I'd mention to you. Complaints were categorized as follows: 42% motor vehicles, 27 homeowners, 14% commercial, 6% householders, and 11 other types. So if a claim is repudiated, and then the policyholder, and policyholders must know that if a claim is repudiated or they're unhappy with their settlement, they have every right to take it to the short-term ombudsman's office. But that means when it gets to the office, how come they are assessing it differently to the claims departments?
So one would need to obviously have it, it's a good question, Bryan. I think the interpretation of that insurance claims department, I mean, the good news is that it's getting challenged. I know a lot of insurers have their own internal office before it goes to the Insurance Ombudsman. So one just needs to understand some of the insurers and the processing that happens when a claim is rejected. But very often, I do know that insurance companies are becoming very consciously checking to make sure that when a claim is rejected, it is within the understanding. In fact, a lot of insurance companies have what you call a claims forum, that they discuss various claims that have been rejected before it gets to that specific door of the Insurance Ombudsman. So the majority of the insurers do their very best to make sure that the claim gets handled within the environment before it goes to the Insurance Ombudsman's office. But again, one would just need to check on some of those processes and just see where it's getting along.
Okay, when we return, I want to talk a little bit about what the effects of fraud is, because there have been a lot of articles recently about insurance companies, medical aids, fraud that's happening. But we're going to take a break. Stay tuned. We'll be back shortly.